David, let's move back to economy then, and well, the continuing banking travails, shall we say. Joe Biden made a comment about the recent banking collapses, the two banks in the United States. Do you want to introduce this little video clip?
Yes, to restore confidence across the whole nation. Who else are you going to call on but President Joe Biden? So he came out and this is what he said.
Before I leave for California, I want to briefly speak about what's happening in Silicon Valley Bank and Signature Bank. Today, thanks to the quick action of my administration over the past few days, Americans can have confidence that the banking system is safe. Your deposits will be there when you need them. Small businesses across the country, the deposit accounts at these banks can breathe easier knowing they'll be able to pay their workers and pay their bills. And their hardworking employees can breathe easier as well. Last week, when we learned of the problems of the banks and the impact they could have on jobs of small businesses and banking system overall, I instructed my team to act quickly to protect these interests. They've done that. On Friday, the government regulator in charge, the FDIC, took control of Silicon Valley Bank's assets. And over the weekend, it took control of Signature Bank's assets. Treasury Secretary Yellen and a team of banking regulators have taken action, immediate action. And here are the highlights. First, all customers who had deposits in these banks can rest assured they'll be protected and they'll have access to their money as of today. That includes small businesses across the country that bank there and need to make payroll, pay their bills, and stay open for business. No losses will be, and this is an important point, no losses will be borne by the taxpayers. Let me repeat that. No losses will be borne by the taxpayers. Instead, the money will come from the fees that banks pay into the deposit insurance fund. Because of the actions that our regulators have already taken, every American should feel confident that their deposits will be there if and when they need them. Second, the management of these banks will be fired. If the bank is taken over by FDIC, the people running the bank should not work there anymore. Third, investors in the banks will not be protected. They knowingly took a risk, and when the risk didn't pay off, investors lose their money. That's how capitalism works. And fourth, there are important questions of how these banks got into the circumstance in the first place. We must get the full accounting of what happened and why those responsible can be held accountable. In my administration, no one is above the law.
Now, apart from stumbling over the line, no one is above the law, which I thought was quite interesting. There's a few other things in there. He's basically said that only quick action by the government saved the banks. I thought that was essential. The banks are safe because of the rapid response by his administration, not because the banks are sound. So I thought that was quite interesting. Next thing he said, all deposits are protected. Now, the deposit protection scheme was for the first $250,000. And in the particular case of the bank that failed, that was only a few percent of the deposits. Almost all of the deposits, 96% or something, wasn't covered by the deposit protection scheme. So what they've done is they've extended the deposit protection scheme massively to cover everything. Now, the deposit protection scheme only has assets to cover a tiny fraction of the insured funds across the banking system. So they've taken something which was already extremely thinly spread, and they've spread it much, much wider. But this is meant to restore confidence. I'm not sure that it will. He talks about it's all going to be paid for by the banks, well, actually by the bank depositors, because that's where the money comes from. And then he says investors are not protected. That's how capitalism works. Actually, technically, if you deposit money in a bank, you are lending your money to the bank, and you're an unsecured lender, I'm afraid. So when Biden starts talking about that's how capitalism works, and it's targeting somebody else doesn't necessarily stop there. So overall, I thought this was essentially a move to bail out failing institutions, to shore up and attempt to restore confidence in the banking system, because confidence had actually plummeted. It was looking pretty dark when he came out to make that statement. And overall, I thought a less than convincing performance, and one which cuts across other elements of the American state and what they are doing. He's basically saying to the voters, everything's okay, you don't have anything to fear. Meanwhile, the banking system crisis hasn't been resolved. What do you think, gentlemen?
That is indeed the case, and I just want to highlight one point. At the end of that is, no matter what you might think about the rest of the speech, but the last sentence about no one being above the law, that's a simple lie. That is a simple lie, because he is breaking the law. Let's put the law on screen. Here's the FDIC law, Regulations Related Acts, Section 11. Let's get the quote. Net amount of insured deposit. The net amount due to any depositor at an insured depository institution shall not exceed the standard maximum deposit insurance amount as determined in accordance with subparagraphs C, D, E, F, and paragraph 3. And that figure, David, is $250,000. There is no scope for changing $250,000 other than for minor adjustments as a result of inflation. It does not say that it is legal. In fact, it quite clearly says it's illegal to simply open the taps and bail out the banks to whatever figure you happen to choose. So for Biden to simply say at the end of his comment there that no one is above the law, not only is it a lie, but he really needs to reconsider his own position.
It's a very good point. And of course, why they're doing this is because there was panic. Right? There was a serious threat here, and they're trying to do the confidence trick. The Irish government did this some years ago. They announced, somewhat smugly, that they just organised the cheapest bailout in banking history, because they'd said that the Irish government stand behind the Irish banks, and that restored confidence, and the confidence restored the integrity of the banks. So everything was okay, and it didn't cost a penny. Well, and then all of a sudden it did cost a penny, because the real problems in the banks were still there, and only now in this case, the Irish taxpayer was on the hook, and the Irish taxpayer was fleeced. The country was put into horrendous debt in order to bail out its banking system. Now, they're saying it's not going to be the taxpayer, but the insurance scheme, which they are claiming is covering all of this, cannot cover much more than the banks that have already gone down. And the next recourse is to the Treasury. That scheme has recourse to the United States Treasury. So to say, well, there's no taxpayers' money going on this, it leaves out the key word, yet.
Yeah. And then the other question I had in my mind, as it was, I didn't mention this on Monday, but of course, Silicon Valley Bank was employing somebody by the name of Lehman. Well, apparently the Mail has picked this one up. So let's bring this on screen. Former Lehman Brothers CFO was hired by SVB and recently appointed risk manager. I mean, who would? I mean, would you employ?
Yes. You would employ. Well, this is if I may, David. I think this is a key thing. In the earlier bit of the segment, regulators were mentioned. Well, of course, the regulators are absolutely in bed. They are an inherent part of the banking system itself. So this is supposedly a self-policing organisation. We can see what is clearly negligent and or criminal activity, but when we look for who the policemen are going to be, we find that it's the same people.
Yes, this is parallels with the farmer, isn't it?
It parallels with the big pharma industry.
It's very similar to Big Pharma, you're quite right, but it's actually worse than you just stated there. So we've got this chap here who, his name Joseph Gentile, And he was chief financial officer at Lehman up to 1 year before Lehman collapsed. So when all the mistakes were made, he was chief financial officer. And he went on to become chief administrative officer at Silicon Valley Bank. And, well, we know how that worked out. They also say that they had a long time without a risk manager during the point where all the risk was cranking up. And they then got a risk manager from Deutsche Bank, which has got a bit of a troubled past as well. But the point you made there, Brian, about who regulates them, well, of course, this is part of the Federal Reserve System, and it was the local Federal Reserve Bank that was the regulator for Silicon Valley Bank. And on the board of that Federal Reserve Bank was the chief executive of Silicon Valley Bank. He was essentially checking his own homework.
Yes. Where does that take us? Financial Times here, banks are designed to fail.
Now, this is actually, I do suggest people search this one out, because it's actually a very good article. There's a part 2 to come next week. We'll see if that's as good. But this is Martin Wolf writing. He said, banks fail. When they do, those who stand to lose scream for state rescue. And if the threat and costs are big enough, they will succeed. This is how, crisis after crisis, we've created a banking sector that's in theory private, but in practice a ward of the state. I think that's a very good way of putting it. The latter in turn attempts to curb the desire of shareholders and management to exploit the safety nets they enjoy. The result is a system that is essential to the function of the market economy, but does not operate within its rules. This is a mess. This is a very good summary. So he continues on here. He said, banks are not designed to be secure. Their deposit liabilities are supposed to be perfectly safe and liquid, and their assets are subject to maturity, credit, interest rate, liquidity risks. They are fair-weather institutions. In bad times, they fail, and depositors run for the door. Again, a very good summary of what a bank is. So over time, the state institutions has responded to the inability of banks to provide safe money their depositors expect. So you had the 19th century central banks came along to be lenders of last resort. In the early 20th century, governments guaranteed the smaller deposits. Then in the financial crisis of 07-09, they basically put the entire balance sheet of the government behind the banks. The banking system as a whole became part of the state. And in return, capital requirements were raised. Liquidity rules were tightened and the stress tests were introduced. And did this work? Well, no. Now, we've got a graph here that shows just how bad things actually are, because this is all about the quality of the assets the banks are holding. Not only are these assets illiquid, they can't easily sell them, and you've got a demand deposit, and you can go down to your bank and demand the money at any time. But the value of these securities, things like government debt, is falling. As interest rates go up, the value of the bonds already issued falls. And you see here just how much the unrealized losses on these banks' balance sheets are. So obviously SVB was basically wiped out by this, but all of the banks are hugely affected. If you take, say, US Bancorp down the bottom there, they've got, in theory, 8% equity to Tier 1 capital ratio. So they've got 8% of the what's on their balance sheet they have in actual equity within the bank, but actually it's more like 4%. So this means that all of the banks are much more vulnerable than they claim to be because of the falling value of the assets that they hold. And then the next chart shows just how bad this is. Now remember, the Federal Reserve has basically said that they will take these assets in and will lend on them at par. So they're underwriting. They're essentially offering to put this loss on the Federal Reserve Bank's balance sheet for a year. And how much are we talking about? Well, this is not current. This is at the end of December. Right now, it's probably a lot worse. But the unrealized losses in the banking system in the States is round about $600 to $700 billion, which in anyone's world is a lot of money. So this article concludes, the fundamental lesson we have to learn is that even in a modest crisis, deposits cannot be sacrificed. Rules on haircuts for provision of liquidity will go out the window. Banks' awards of the state, partly because they're at the heart of the credit system, but even more because their deposit liabilities are so politically important. That's the key point. He says the marriage of risky and illiquid assets with liabilities that have to be safe and liquid within undercapitalized, profit-seeking, bonus-paying institutions regulated by politically subservient and often incompetent public sectors is a calamity waiting to happen. Banking needs radical change. Now, I thought that was a wonderful summary of just what the situation is. Part 2 next week will apparently say what he thinks the change should be. So we'll see what we think of that.
But in the meantime, I mean, there's a couple of points I want to make about that, but we'll keep that for extra. In the meantime, in Switzerland, Credit Suisse is, also in trouble. So it's not just the United States banks.
No, you can't make it up. So Credit Suisse, right? This is Swiss. Well, this is allegedly Swiss banking, although they're now international. They're not quite as Swiss anymore. They've got a problem because they've got material weaknesses in their financial reporting mechanisms, and they're not able to accurately report about their financial condition. The bank admitted they were going to have to dedicate significant resources to fixing its financial reporting, and this could prevent the bank from providing reliable financial information to investors. How much worse could it possibly be? The Times continues, the warning comes after Credit Suisse reported its biggest annual loss since the 2008 financial crisis, and has said it would suffer another substantial loss in 2023. That loss, incidentally, was £1.24 billion in the fourth quarter of last year alone. So Credit Suisse not looking good, and really what they're saying is they don't actually know, they can't be sure how bad it is.
Indeed, but then it's hardly surprising because central banks, the Bank of England in particular, don't have a clue what's going on either.
I did this so you don't have to, viewers. I watched the Bank of England press conference as they announced their February monetary report, and I had to sat there and watched this strange performance where apparently the Bank of England, who'd created the inflation by creating all of the money when we shut down the economy during COVID, apparently they'd no idea this had anything to do with it. And they were talking about inflation as though it's something just to do with supply and demand and prices. It's like they don't know what the words mean. Now, I don't believe, we've talked about whether they're incompetent or not. I don't believe they're that incompetent. That's simply pulling the wool over the eyes of the public. The BBC were there to have the wool pulled and were completely impervious to what was going on. They were saying, essentially, inflation has come down a tiny tick, still over 10%, but that shows we've turned the corner, everything's going to be fine. Not to worry our pretty heads. And when you look at the prediction, well, inflation's going to plummet down to, almost nothing very quickly. So they're telling us inflation is completely beaten. There's still risks, right? They're couching it in terms where, they can get out if it doesn't work out. They can say, well, we kind of warned you, because that's the way these reports are written. They always give themselves outs. But they're basically saying inflation's licked, don't worry about it. Now, I don't believe that, because the money creation was so egregious, and that's what inflation actually is. It's expansion of the money supply. That's the thing that they were not talking about in their press conference, and the BBC were kind enough not to ask them.
And it hasn't stopped.
Yeah, just one question, David. Was he speaking for the Bank of England, or was he actually speaking for the Bank of International Settlements? Because, of course, that gentleman steps seamlessly between the Bank of England and the Bank of International Settlements, and yet the Bank of International Settlements activities in UK are beyond the gaze of the UK public. Who was he working for?
Well, he's speaking for the Bank of England. He was speaking for the Bank of England, and he was speaking in this kind of strange grey world between public and private, just as the Fed operates in this. Is it public? Is it private? And if it's public, can we know about it? Well, not really, because it's all confidential. And we have this very woolly system where accountability, responsibility doesn't seem to happen. And then when things go badly wrong, it's always the same course. It's always money printing, so that you have stealing wealth from the people by stealth, by inflation, and taxation, stealing wealth from the people by more direct and obvious means. It's either the taxpayer or it's inflation, because those are the only two tools they've got in the end of the day.
Okay, thank you very much for that.